It is Rohi Support Program official YouTube channel. Introduction to Agricultural Value Chain Finance, AVCF. Agricultural Value Chain Finance, AVCF, is a strategic approach to financing that leverages the interconnected activities and relationships in agricultural value chains to provide more efficient and effective financial services. This methodology aims to address the unique challenges faced by smallholder farmers and other value chain participants, improving their access to finance and enhancing the overall performance of the agricultural sector. In this blog, we will delve into the key concepts, benefits, and implementation strategies of AVCF, providing a comprehensive understanding of this innovative financial model. Understanding value chains. A value chain encompasses the full range of activities required to bring a product from its initial conception to its final consumption. In agriculture, this includes everything from input supply, production, and processing, to distribution and retail. The value chain framework provides a holistic view of the agricultural sector, highlighting the interdependencies between different stages and participants. Key participants in agricultural value chains. Input suppliers. These are entities that provide the necessary inputs for agricultural production, such as seeds, fertilizer, and equipment. They play a crucial role at the beginning of the value chain. Producers, farmers. This group includes all individuals and entities engaged in primary agricultural production. They are the backbone of the value chain, converting inputs into marketable products. Aggregators, traders. These participants collect agricultural products from farmers and supply them to processors or markets. They are essential for consolidating produce and facilitating market access for smallholder farmers. Processors. These entities add value to raw agricultural products through processing activities. They often face challenges related to working capital and investment in equipment. Retailers, wholesalers. This group sells processed products to consumers or other businesses. They often manage complex credit relationships and require substantial working capital. The flow of finance in value chains. In traditional finance, various financial institutions may lend to different participants in the value chain independently, without coordination. In contrast, AVCF promotes a coordinated approach to financing, considering the entire value chain's needs and relationships. This can lead to more efficient use of resources, reduced transaction costs, and improved access to finance for smallholders. The importance of AVCF. AVCF addresses several critical barriers to agricultural finance, such as high transaction costs, perceived high risks, and the lack of collateral among smallholder farmers. By leveraging existing relationships and information within the value chain, AVCF can significantly reduce these barriers and provide tailored financial solutions. Benefits of AVCF. Improved access to finance. AVCF expands financial access to smallholders who are often excluded from traditional banking services due to their lack of collateral and perceived high risks. Enhanced risk management. By understanding the entire value chain, financial institutions can better assess and manage risks. This includes diversifying risk across various value chain participants and leveraging contractual relationships to secure repayments. Lower transaction costs. Coordinating financial services within the value chain reduces the need for redundant processes and improves efficiency. This leads to lower transaction costs for both financial institutions and value chain participants. Increased financial inclusion. AVCF promotes financial inclusion by integrating smallholder farmers into formal financial systems. This can lead to broader economic development and poverty reduction. Key components of AVCF. Internal versus external financing. Internal financing involves value chain participants financing each other, such as input suppliers providing credit to farmers. External financing involves financial institutions providing loans based on the relationships and information within the value chain. Customized financial products. AVCF requires the development of tailored financial products that meet the specific needs of value chain participants. This includes working capital loans, investment financing, and insurance products. Partnerships and collaboration. Successful AVCF relies on strong partnerships between financial institutions, value chain participants, and other stakeholders, such as government agencies and NGOs. Implementing AVCF, a step-by-step approach. Implementing AVCF requires a systematic approach that involves several key steps. 1. Identifying target value chains. The first step in implementing AVCF is to identify the value chains that present the most viable opportunities for financing. This involves assessing both the commercial viability and the potential impact of financing within different agricultural sectors. Commercial viability. Assessing the commercial viability of a value chain involves analyzing factors such as industry growth, investment levels, price volatility, and market size. Financial institutions need to understand the economic dynamics of the value chain to ensure that it presents a sustainable business opportunity. Impact potential. It is important to consider the potential impact of financing on smallholder farmers and other value chain participants. This includes evaluating how financing can improve productivity, increase incomes, and enhance resilience to risks. 2. Mapping the value chain. Once a target value chain has been identified, the next step is to conduct a detailed mapping of the value chain. This involves identifying all key participants, understanding their roles and relationships, and analyzing the flow of products, finance, and information. Participants and relationships. Mapping the value chain requires a comprehensive understanding of the different participants and their interactions. This includes identifying input suppliers, producers, aggregators, processors, and retailers, as well as the formal and informal relationships between them. Financial flows. Understanding the flow of finance within the value chain is crucial for designing effective financial products. This includes analyzing how different participants access finance, the terms and conditions of financial arrangements, and the timing and volume of financial transactions. 3. Developing financial products. Based on the insights gained from mapping the value chain, financial institutions can develop customized financial products that meet the specific needs of value chain participants. This involves designing products that are tailored to the unique characteristics and requirements of the value chain. Working capital loans. Working capital loans are essential for supporting the day-to-day operations of value chain participants. These loans provide the necessary liquidity for producers, aggregators, and processors to purchase inputs, manage inventory, and cover operating expenses. Investment financing. Investment financing is required for long-term investments in equipment, infrastructure, and technology. These loans enable value chain participants to invest in productivity-enhancing assets and improve their competitiveness. Insurance products. Insurance products are crucial for managing the risks associated with agricultural production. This includes crop insurance, weather insurance, and livestock insurance, which help mitigate the impact of adverse events on value chain participants. 4. Building partnerships. Successful implementation of AVCF requires strong partnerships between financial institutions, value chain participants, and other stakeholders. Building these partnerships involves identifying potential collaborators, establishing mutual goals, and developing mechanisms for coordination and cooperation. Financial institutions. Financial institutions play a central role in providing finance and managing risks within the value chain. They need to work closely with value chain participants to understand their needs and develop appropriate financial solutions. Value chain participants. Value chain participants, including farmers, aggregators, and processors, are key partners in AVCF. Their participation is essential for ensuring that financial products are relevant and effective in meeting their needs. Government and NGOs. Government agencies and NGOs can provide valuable support in implementing AVCF. This includes facilitating access to finance, providing technical assistance, and creating an enabling policy environment for value chain finance. 5. Monitoring and evaluation. Monitoring and evaluation are critical for ensuring the success and sustainability of AVCF initiatives. This involves tracking the performance of financial products, assessing their impact on value chain participants, and identifying areas for improvement. Performance indicators. Key performance indicators, KPIs, should be established to measure the success of AVCF initiatives. These may include metrics such as loan disbursement volumes, repayment rates, and the financial performance of value chain participants. Impact assessment. Impact assessment involves evaluating the broader effects of AVCF on value chain participants and the agricultural sector as a whole. This includes assessing changes in productivity, income levels, and resilience to risks. Case studies. Successful implementation of AVCF. Several case studies highlight the successful implementation of AVCF in different agricultural value chains. These examples demonstrate the potential of AVCF to improve access to finance, enhance productivity, and promote economic development. Case Study 1, HDFC Bank in India. HDFC Bank implemented AVCF in the hybrid seed production value chain in India. The bank partnered with seed companies and aggregators to provide credit to smallholder farmers. By leveraging the relationships and information within the value chain, HDFC Bank was able to extend credit to farmers without requiring traditional collateral. Key outcomes. 1. Improved access to finance for smallholder farmers. 2. increased productivity and income levels for farmers. 3. Enhanced relationships between value chain participants. Case Study 2, Habib Bank Limited in Pakistan. Habib Bank Limited, HBL, implemented AVCF in the dairy value chain in Pakistan. The bank partnered with large dairy processors to provide financing to smallholder dairy farmers. This initiative helped improve the financial inclusion of smallholder farmers and enhance the overall performance of the dairy sector. Key outcomes. 1. Increased financial inclusion for smallholder dairy farmers. 2. Improved productivity and milk quality. 3. Strengthened partnerships between dairy farmers and processors. Case Study 3, Bancool in Mexico. Bancool implemented AVCF in the horticulture value chain in Mexico. The bank developed a methodology to identify viable value chains and tailored financial products to meet the specific needs of value chain participants. This approach helped improve access to finance and enhance the competitiveness of the horticulture sector. Key outcomes. 1. Enhanced access to finance for horticulture producers. 2. Increased investment in productivity-enhancing assets. 3. Improved market access and competitiveness. Conclusion. Agricultural Value Chain Finance, AVCF, is a powerful approach to financing that leverages the interconnected activities and relationships within agricultural value chains. By addressing the unique challenges faced by smallholder farmers and other value chain participants, AVCF can significantly improve access to finance, enhance risk management, and promote economic development. Successful implementation of AVCF requires a systematic approach, including identifying target value chains, mapping the value chain, developing customized financial